Citadel has a huge leverage problem. That's what we're going to talk about here in this video. They may even go bankrupt during the next financial downturn. We're going to talk about what happened in 2007 and 2008 with Citadel, go over the margin levels currently, as well as take a look at a very interesting article suggesting that the Fed is actually trying to downplay the margin that is outstanding in the overall economy. Very exciting information. I think all of you guys will get a ton of value out of it. Hit that like button for me, consider subscribing to the channel, as well as that let me know in the comment section what do you guys think about all of this information. And if you guys do hear any noise, they are actually cutting down trees for the power lines right outside my house right now, so I do apologize for that if it does get picked up here on the mic. So let's dive into this video with Citadel's portion of this video. Now, you have to watch the whole video for this all to come together and make sense, but Citadel is in a huge bind. So this says Chicago-based Citadel appears to be the most leveraged of the 25 biggest U.S. hedge funds, with an implied leverage of about 8.8 times investment capital, according to a Post analyst. That is a major, just crazy level of leverage that they have going on. This is documented, this is true, this is facts. They like to use a lot of leverage, and leverage can be good on the way up, but it can also be very bad on the way down. We all know that. Leverage compounds gains, and it also compounds losses a lot faster. And they are setting themselves up just to do the same thing they did in 2007 and 2008. If you take a look at this, this is on Wikipedia for obviously Citadel LLC. You guys can see in 2007, Citadel invested $2.5 billion in E-Trade. This transaction included acquiring E-Trade's securitized subprime mortgages, collateralized debt obligations, CDOs, and second lien loans, as well as 12.5 senior unsecured notes and 84,687,686 shares of common stock, equal to about 20% of then currently outstanding shares. Citadel received a seat on the board of directors. Citadel sold its remaining stake in E-Trade in 2013. During the financial crisis of 2007 and 2008, for 10 months, Griffin barred his investors from withdrawing money, attracting criticism. At the peak of the crisis, the firm was losing hundreds of millions of dollars each week. It was leveraged 7-to-1, and the biggest funds at Citadel finished 2008 down 55%. However, they rebounded a 62% return in 2009. So they never learned their lesson through 2007 through 2008, losing 55% when the markets were going through a major downturn, the global financial crisis, but still continued to use that over leveraging tactic that got them there in the first place and rebounded 62% in 2009. This is going on right now, but on a much larger scale, a much larger scale. Citadel back then was worth a fraction of what they are today. Now they are a powerhouse in the financial community, and arguably some people think they are too big to fail. That is not the case at the current moment. They are not too big to fail. That's what we're talking about here in this video. And when you are leveraged 7-to-1, or in this case over 8-to-1, once you even see smaller corrections in the marketplace, you're going to see big reductions in your overall fund's value. Why is this all so important? Because we're not currently going through a major downtrend, but one could just be around the corner. And one would argue and go as far as to say the markets have rallied over 100% in the last 18 months. We could certainly keep going or trade sideways, but eventually we are going to have another 20, 30, 40% pullback, and we would still be much higher than where we were just 18 months ago when the pandemic did start. What is an even bigger issue for Citadel at the current moment than that, and will ultimately compound their losses that they see when the market does go through a downtrend, is the fact that they have been accused over the past year of market manipulation, which is arguable that they did or did not have a part in that. But you even see hedge funds not even willing to hire old Citadel employees because they don't want to be a part of that whole debate and that scandal situation that has been going on over the past year. Now, this is more speculation on my part, but I do think it's safe to say that Citadel is going to be seeing massive redemptions at their hedge fund throughout the rest of this year. This should drive their liquidity levels down, and we know Citadel loves leverage, so they're going to do everything they possibly can to not make that reflected in their books, because that could spark a chain reaction and cause most investors to want to get out of their Citadel positions. Citadel only returned 18% throughout the past year when the markets are up 30% with the S&P 500. I think this could all culminate into a really bad situation for Citadel. And if they truly do have a massive short position, because we are not reported this under SEC law, hedge funds or anybody does not have to report the amount of shorted shares they have. We know they have a large short position, but this could ultimately force them to cover on all of their short positions, cover on their put short positions as well as their share short positions. So I think that's more logical. I think that's kind of common sense. You don't really want to be a part of anything Citadel in the financial markets at the current moment. So that's what really we had to go over. As far as the margin debt that is outstanding, we have went up 42% year over year with margin debt. This is a big issue. This just highlights the over leveraging that is happening in the broad economic system and in our financial markets. Like I said, I will say this again, margin compounds your gains but also compounds your losses once the market goes through a downtrend. So once those margin calls go out, people have to liquidate more stocks. Those people have their stock values going down, other people, and they also have to start liquidating. So this is going to be a huge chain reaction. And just from January 2021, the margin debt was at $798 billion. Today, it's at $935 billion. That is a massive increase, and that is not something we should be disregarding in that sense. Now, let's move on to that. Let's go over this article. So this is very interesting. This is something I came across. It's from October 17th, 2021. It says, banks disclose tidbits of hidden stock market leverage of securities-based lending. How much total leverage there is in the stock market. Only fragments are reported. Some types of leverage are not disclosed at all until something implodes, such as Archegos. A few months ago, in its financial stability report, while pointing at Archegos, the Fed warned out of the other side of its mouth about the vast unknown parts of leverage among hedge funds and insurance companies. We're going to skip down to exactly what SBLs are, because that is very, very important. It says some banks and brokers report securities-based lending, others don't. On Thursday and today, some Wall Street banks and brokers filed their Q3 earnings reports and supplemental information with the SEC. And a few of them included in their supplemental filings some tidbits about their securities-based lending. Securities-based lending is hot. People who want to cash out some of their gains in their portfolios, thank you, hallelujah, Fed, but didn't want to sell, can use their portfolios as collateral for loans by the broker, the proceeds of which can be used for anything: buy more securities, buy a house or a new vehicle, or pay for a divorce settlement. When asset prices fall, though, the borrowers get a margin call and either have to come up with some cash and put it into the account, or they have to sell securities and pay down their SBL balances, thereby turning into forced sellers. And right here, this is very important. These are all of the biggest banks, or a majority of the biggest banks. So Goldman Sachs didn't disclose anything about its SBL. They're lumped into a larger loan category. We do not get numbers for that. JP Morgan, which probably has the highest SBL numbers, only reported that their loans continue to be strong, up 20%, primarily driven by securities-based lending. So we got no numbers about that. I imagine it's well over $100 billion. Bank of America disclosed its securities-based lending in a footnote. SBL balances in Q3 jumped by 25% year over year to $49 billion. Morgan Stanley also disclosed its SBL balances. In the category securities-based lending and other, spread over two divisions, which combined jumped 23% year over year to $89 billion. Charles Schwab didn't separate its SBL balances, but lumps them into a category of receivables from brokerage clients, which nearly quadrupled year over year to $81 billion. Wells Fargo reported that other customer loans, which are primarily SBLs, declined by 18% in Q3 to $27 billion. The decline might be a side effect of the sale of its asset management business to private equity firms GTCR and Reverence Capital Partners, announced in February this year. No one tracks the overall outstanding balances of SBL. Each bank knows its exposure, you'd hope. Many banks lump them into other loans, and there is no overall summary figure, and no one knows how much leverage there is in the stock market in terms of these securities-based loans. But we know it's huge and ballooning, given the amounts that are disclosed by a few banks. And if you just add up the actual numbers that were disclosed, not including JP Morgan or Goldman Sachs, which are probably going to have the highest number of these SBL loans, you come out to $246 billion worth of these securities-backed lending loans. So that means if you add that to the margin debt that is known to be outstanding, $935 billion, you are well over $1.2 billion trillion dollars of margin debt outstanding. Just incredible amount of debt that is in our financial markets. It says, and you guys see this chart right here going over the margin debt, what has been happening, and it says margin debt blows out, then dips. Regular margin loans are reported by brokers to FINRA, which then reports them on a monthly basis, which it did today. They are the only measure of the stock market leverage that is tracked. It's an indicator of the trend in overall stock market leverage, the tip of the iceberg. Stock market margin debt, after spiking to another all-time high in August, ticked down in September to $903 billion, up 38% year over year and by 61% from January 2020 before the sell-off started. What's important in a chart like this that spans over 2 decades is not the absolute level of leverage compared to back in the day, because the purchasing power of the dollar has diminished. What's important are the trends and patterns, the steep increases before every stock market sell-off. So they are basically indicating that because we are seeing this big increase in margin debt from March of 2020, you guys can see right here when we were at under $450 billion of margin debt, all the way up to, if you include SBL loans, $1.2 trillion worth. You do see a major sell-off after you get to those high margin levels, and this is the biggest increase by far that we have ever seen. Spikes in margin debt don't trigger sell-offs, and they don't predict sell-offs because they sometimes lag those sell-offs. But leverage pumps up stock prices by creating buying pressure as borrow money surges into the market, and when the market tanks, forcing selling by leverage investors creates selling pressure and amplifies the sell-off and triggers its own downward spiral. The Fed has repressed interest rates to encourage borrowing, and it contributed to this spike in leverage. And to make it all work out, it inflated asset prices via $4.5 trillion in quantitative easing in 18 months as part of its official wealth effect policy. A few months ago, in its financial stability report, while pointing at Archegos, it warned out of the other side of its mouth about the vast unknown parts of leverage among hedge funds and insurance companies. This is an incredible article. I will link down below in the comment section. If you guys do want to take another look at it, it will be not in the comment section, but in the description of this video. That is mainly going to wrap this up. Hopefully by now you have a sense of what is going on, particularly with Citadel and what is happening with the overall margin debt and just how much of this we don't actually know about. If you include everything that we have talked about in this video, Citadel is in a very bad situation at the current moment. Hopefully this all does resonate with you guys and make some sense. So hit that like button for me, consider subscribing to the channel, as well as let me know in the comment section, what do you guys think about this information? I think it's pretty remarkable if you break it down in this sense. As well as that, check out the links in the description for free stock if you guys want to support the channel, as well as if you guys want to get access to all of my trades in real time. The link for the buy and sell alerts is also down there as well. Definitely check that out. So that is all for this video. You guys enjoy the rest of your day, and I will see you in the next one.